Hello, this is 13 with Silk Trades. Today we're going to be talking about risk and money management. This is going to be the first video I make, so forgive me if things sound a little bit weird or things don't go as smoothly as planned. We're just going to be using a slideshow for this particular one. In the future, I'm hoping to do some live video trades of, stock trading, or when I'm working on an ER, I can live feed it, probably show some insight into what we do here. Let's just get straight into it. So securing a safety net is essentially making sure that, let's say the stock market crashes or anything like that, that you will be safe. Even if the stock market crashes, I definitely recommend holding your shares. Usually you don't even really want to sell your shares if you have a price target in mind if you're playing in the stock market. But ideally, what it means is, let's say you're you have monthly subscriptions, you have rent, you have all these bills you need to pay every month, right? You need to add all that up, and you need to have at least 6 months of that saved in a secured account that you will not touch. This will basically give you a safety net of 6 months in case anything happens. Let's say your car breaks down, or something weird like your house burns down or something like that. You want to make sure you have money to help out and sustain whatever life you're living. And as long as you have that, you should be able to play in the market and go to bed and not have to stay up at night worrying about it. If you get into anything where you can't get a good night's rest, that is a pretty good indication that you probably should not be in that investment. So this is a pretty clear example of what I'm saying. This is just random numbers I made up. So $900, $60 in monthly subscriptions, 150 in gas, and groceries are like 400 a month. So all that every month, you want to add all that up, times it by six. That's how much you'd want in an emergency fund account. That's the base of what you want before you even start getting into the US market. Now, to create a base in your investment portfolio, that's going to be a ideally you want to make sure you follow this type of program. I notice a lot of people are, options are definitely fun to do. Uh, but I would be lying if I told you that there isn't some type of gambling that is around it. It's definitely way more risky. I actually only put about 5% or less of my portfolio into an options trade at all times. Uh, when we get options trade and we make about 200%, that's still only going to be about 1% profit from my portfolio, but that's what I aim for. Every week I aim to make at least 1%. As long as you're making 1%, you will be very, very rich in a very quick time. Uh, that basically gives you a 52% annual return. The US market performs at about 15 to 17%. You are beating the market by far. So try and aim for that 1%. As time goes on and you understand technical readings, you can start moving towards that 5% a week. But if I make 1% a week, I'm happy. So let's get right into it. So ideally, to reduce risk and diversify your portfolio, you would want to have 80% of your account in stocks. So these are going to be like SPY, Vanguard ETFs, Dow, QQQ, things that aren't going to be very volatile. They're going to be safe to hold. You want to hold these for basically 10 to 20 years. Usually, if a stock market crash happens, that would be the only concern you would want to be worried about. But as long as they're in stocks, your contracts won't expire. You won't have to worry about, let's say you tried shorting, you won't have to worry about paying on margin. This is ideally what you want to have before you even get into option trading or crypto trading or playing any ERs. This will essentially guarantee you that, on an annual rate, you'll make 15-20% off of your entire portfolio. I usually keep 10% in cash for any events that may pop up. And when I say that, a good example is Tesla. Elon Musk smoked weed and basically tried to private his company by targeting it for 421. Uh, he thought it would be funny to change it to 420, and the SEC, filed against him, and he had to pay money, and he's not the CEO anymore. Price plummeted. That 10% in cash, you can use it to short the stock. You hear that type of news, you have plenty of time to short the stock. Um, if you have all of your money not available, you have 90% in stocks, let's say, and then you have like 10% in your options, and no cash, no liquidity in that. You do not want to be stuck in a position where you have shares in a specific company. Like on Friday, October 5th, we saw a really, really red day. And if you didn't have any cash available, you'd have to sell some of your shares at a loss to even get into an opportunity to short a stock. So that's really important to remember. 10% is pretty conservative, or no, I would say it's a little bit on the bigger side. I know some people that are okay having only 5% in cash. It really depends on your portfolio size. 10% in cash for me will guarantee me any entry I really want to get into. I could get into Amazon or anything like that. So make sure you think about that while you're trading. Um, Another good thing is when you create the base for your portfolio, you want to have that 80% in stocks, but most of that money you're going to want to first put into ETFs like SPY, VU, DIA, and then that will be a good start for your portfolio as you grow your account. These are very important metrics that I like to discuss. I know a lot of people in our group don't really know them or understand them, so I thought I would go over them today. Stop loss point. I personally don't use a stop loss on my trades, but I do have a mental stop loss. As I watch the 50 SMA line and the 200 SMA line, also the RSI, uh, I want to remember exactly what those numbers are going to be, so I know when to sell or when to, sell for a profit. If it's going to break under the 50 SMA, I want to sell that as quick as I can. I'm going to take that loss. I'm going to minimize my loss. I'm not going to get stuck on a trade that I think will be profitable. It's very important to be humble with your trades. Know when you were wrong, okay? When I look at certain stuff like Nike or let's say Apple, right? I tried shorting Apple during earnings. That was a bad call on my part. As the price rose, I instantly sold. It's just not a good thing to hold something. Effectively, if you're gonna go into a trade and you're not even gonna come up with a plan, you are gambling in the market. You need to figure out your stop loss and your take profit point. That's basically going to be for me personally, I wrote it as an example. It is when it reaches a key resistance point, I will sell it before it starts consolidating in a price range. Ideally, I personally do that because once it hits that key resistance point and it doesn't have enough volume because it already had an uptrend up to that point, you're not going to be profiting that much more if you decide to hold. You actually stand to lose a lot more. If it doesn't hit that key resistance, it doesn't break through, you stand more to lose if it starts consolidating in that field. It could, tread down more if the RSI is at 65. So you really want to make sure you have a good stop loss point, you have a good take profit point, and you stick to those. If you're a new trader, if you don't really trust in yourself to follow in those, um, I know Robinhood, I know a lot of brokers do have stop loss points. I believe they have a take profit point too. On the app, it should say, I believe it says like stop sell or something. I can figure it out later for sure. But while looking at these, you know, make sure you're reading this. Traders should always know when they plan to enter or exit a trade before they execute. By using stop losses effectively, a trader can minimize not only losses but also the number of times a trade is exited needlessly. I noticed this in a lot of trades that our group is doing. Make sure that, or give me a sec. When you're holding something, you need to figure out a plan. If you don't figure out a plan, the price moves even a dollar, you start emotionally trading. You're worried, you're panicked, you don't even know why you got into the trade. That's something you really don't want to do. Especially a good example is the Nike ER we played. We were pretty bullish on Nike based off of reports, based off of year over year sales at the same stores. We hypothesized that Nike would be excelling, especially during winter time. So there's no reason not to get calls for them. Uh, During the report, actually, the earnings call, the price went down, I believe, about 6%. That's when we kind of try to analyze the report to see if we were wrong about our estimates, but we were spot on. Everything looked clean and crisp. Revenue was good, EPS was good, guidance was good. Nothing really wrong with the report. Nothing to indicate that the price should go down by that much, that significant amount. So, you could basically say that was just a market maker basically affecting the market. Anything like that, you really want to keep an eye on because if you really believe in the company and the company has a proven track record of making revenue and being a company you can trust and has physical products that people appreciate, there should be no reason you should panic. We looked at that. I believe Nike was at 83 or 84, dropped down to 80. Right after that, right in the morning, we alerted that, within a day, Nike should go back out to its regular price. There should be literally no reason for it to do that. The only reason I could have thought was a market maker was short in the market and he needed to get out of his position, so it was a quick sell. A lot of new investors, millennials especially, would get into Nike. It's a very known company. A lot of traders that see that Nike go down in the morning, they would sell instantly if they're scared. So that was what we assumed would happen, and within actually a couple hours, Nike went back up to 85, and we were actually able to sell at a profit. But as you can see, if you panicked, you would actually not make a profit. You would actually get screwed out of that trade. So it's really important to stick to your stop loss points, stick to your take profit points, and also your fundamental trading. If you look at a report and there's weaknesses in the report, then it makes sense. Sell. If you look at the report and everything you estimated is correct, then keep it. Uh, that is also why option trading is risky because if you get a weekly contract and it expires, you lose all your money and you can't make it back even if Nike goes back up. So this is a very basic understanding of the market. This is going to be a simple technical reading that I like to show. Uh, this is a simple moving average. So these are the SMA lines that I always talk about that people don't really get to know a lot. We have the 200-day SMA and the 50-day SMA. The 50 is the blue one, 200 is red. Um, This is what is known as a golden cross. So 50 SMA goes above the 200 in a upward position. As you can see, this is where you'd want to buy on a technical chart reading. As you can see, right when it hits that, you get that nice spike up. And then as it's kind of recouping, it's trying to stay above the 50 SMA. Once it touches down under a 50 SMA, most people would sell at this point and it would go under. This would be the area that you avoided in terms of loss. Obviously, a stock price isn't going to stick to these lines precisely. That's why you can see it recover pretty quickly. Um, but what's most important is I just want to get these lines across so you guys know exactly what you want to look for on a very basic fundamental understanding of technical reading. As you can see, the 200 SMA line is steadily going up. So now there's going to be an uptrend. So you're not going to be looking at the 50 SMA, making sure it stays above that support. You're actually looking at this line now. Now that this line's at the bottom, that's going to be the new support. You want to make sure it stays above that uptrend. As the 50 SMA is going up here, we're reaching probably overbought territory right here for this company. This is S&P 500 SPY. As we see right here, it's pretty high up there. It's overbought. We can see the 50 SMA going under. As we see the 50 SMA heading a tiny downhill, we can see the stock price plummet back down into this region. This region is known as a death cross. So death cross is going to be the exact opposite of a golden cross. You see the 50 SMA go right under the 200 SMA. That is usually a sign to get out. If you were a excellent trader, there's no way that you'd be able to sell right there unless you you're psychic or you got really lucky. But seeing it go under this, seeing it go under these specific 50 SMA lines can save you money. Even right here, when it goes under, you can have it under the 200 SMA line and rebuy once it reaches above that 200. You save yourself that loss right here. So it's really important to keep an eye on that. Keep an eye on basic technical readings like death cross, golden cross. These are simple strategies that a lot of people use. And because a lot of people use this strategy, when you see something like this, you see a lot of traders actually sell at this point. And when they sell it, it is a bulk volume trade that a lot of people rely on. So that's why you see those prices go down so efficiently. Is because a lot of people use this technical chart reading. Um, and then as you see this bullish golden cross going up over on this side, you see this exact same thing, a bullish golden cross, and you just see it take off. It's just insane. So really try and remember how to read this exactly. So when you're getting into trades, you can get at the bottom as close as to the bottom as you can, and then try and sell at the top. Uh, that will basically be it for today. I just wanted to make a quick video to see how it would work. Obviously, we'll make more detailed videos in the future. If we have any questions on anything that we discussed in this video, like risk management or what you personally think you should be doing, feel free to contact me. I will definitely help you out and set up a portfolio that would work out for you. I understand a couple people in here are just trading options. I wouldn't advise it completely, especially if you can't handle the risk or you start emotionally trading if you're down 50%, because that's what happens when you trade options. As long as you trade only 5% though, over the year, you should see no problem in your account increasing. This is 13 signing off. Have a good night.